Interest rates are to asset prices what gravity is to the apple. When there are low interest rates, there is a very low gravitational pull on asset prices. Given that the present value of any business is sensitive to the discount rate being used, we spend considerable time thinking about the level of future interest rates. Interest rates are the gravity of markets. How long-term interest rates support high valuation, while higher long-term interest rates suppress valuations. There is so much commentary opening on whether or not share markets are under or overvalued, without any discussion about the likely level of future interest rates. We can confidently predict that many stock markets are presently overvalued if future long-term interest rates are 5% or greater, and also predict that they are attractively valued if long-term interest rates are 3% or less in the future. Welcome back, guys, to another video of Framework Finance, where in this video, we will talk about the facts about interest rates. For many years, before the global financial crisis in 2008, it was reasonable to adopt a discount rate of about 9% to 10% based on a long-term interest rate of 5% and an equity risk premium of about 4% to 5%. Investors have historically adopted a proxy for the interest rate within the discount rate, also known as the risk-free rate, has been the yield on highly liquid long-term government bonds such as 10-year US Treasuries or 10-year German bonds. Since the global crisis, greater uncertainty surrounds the discount rate and investors should adopt in assessing the intrinsic value of a business. Post-2008, the major central banks undertook a highly aggressive monetary policy. They reduced short-term interest rates to very low and even negative rates and purchased vast quantities of bonds by expanding their balance sheets, quantitative easing. That has dramatically lowered, even distorting, long-term interest rates. This has made a prevailing yields of long-term US Treasuries and German bonds usually poor benchmarks for assessing the appropriate risk-free interest rate for long-term valuation purposes. We believe investors are, in aggregate, adopting risk-free interest rates at levels materially lower than prevailed before 2008, but higher than the current long-term yields on US Treasuries and German bonds. We can't say this for sure because the risk-free interest rate being used by investors in aggregate is not transparent. In this regard, the uncertainty over the actual risk-free rate created by the policy of the major central banks over the past 10 years has made the investment business more challenging. Without a reliable and transparent proxy, an investor must now make a judgment call about the appropriate risk-free interest rate to assess a business's intrinsic value. The judgment is complex and requires an investor to determine the likely level of future economic growth and inflation in particular. Both of these factors will be determined by many factors, including changes in consumption and investment patterns as populations age, the potential for use improvements in labor productivity, the impact of technological advances, the impact of increased government debt on future consumption and economic growth, the potential trend towards protectionism, the impact of income inequality on policy and labor relations, and so on. Our best judgment is that many economies are likely to enter a prolonged period of more modest economic growth and lower inflation than prevailed over the extended period before 2008. Therefore, we have adopted a lower long-term interest rate than we have used in the past to ensure consistency with these economic views. However, notwithstanding that we have adopted a lower than historic interest rate in our valuation models, we caution that economic cycles exist over the short term. As a result, we could experience a spike in inflation that might cause a spike in long-term interest rates. If this happened, it would be highly disruptive to markets. You have to put appropriate weight on the significant influential variables in investing. One of those variables is interest rates. Warren Buffett recently used an excellent analogy when describing interest rates as financial gravity. If interest rates like gravity are high, they pull the value of other assets down. Conversely, if interest rates like gravity are low, different values float up and away sometimes. The risk-free rate defines the baseline for investing. If you are going to get paid X without taking a risk, sometimes that contains risk needs to return X plus B for it to attract capital. The more risk, the larger B has to be. Relative to previous decades, you can see that today gravity has been removed from the financial system. Gravity, like oxygen, is not a tiny variable. Because of its, shall we say, gravity, much of the financial system has inflated upward. Much, but not all, returns tied directly to the rate are not inflating. To visualize the impact of increasing interest rates even further, let's take a look at the past between 1964 and 1981. U.S. gross domestic product (GDP) increased 373%. However, the Dow Jones Industrial Average closed at 874 on 12/31/1964 and opened on 875 on 12/31/1981. A 1-point gain in 17 years as a result of interest rates increasing from 4% to 15%. Asset prices, however, are not only affected by interest rates but also by fundamentals, forecasting, and the economy. Therefore, I believe fundamentals decide the direction of asset prices, and interest rates determine their magnitude. Late in the cycle, a yield curve inversion can be viewed as a flashing red light for the future state of the economy as investors price in lower growth and inflation. Since the beginning of the year, rising equity valuations are pricing a more positive outlook, with the Fed's dovish insurance cut being the main driver when the stock market is close to all-time highs but the economy is slowing, profit margins are squeezed, and companies are often forced to lower profit guidance. The stock market deviates from its fundamentals and forward outlook, which implies the power put will prolong the market expansion when the stimulus is necessary. The easy monetary policy will lift asset prices, but how much will flow to the real economy? The impact of falling rates have been mixed. Low interest rates have helped stimulate the economy by reducing borrowing costs for consumers and businesses. Everything from borrowing to buy a house or car or issuing bonds to build a factory or buy back stocks has been cheaper due to lower interest rates. And because bond prices move opposite yields, investors have seen total solid returns from bond portfolios through the combination of price appreciation and creation. On the other hand, savers looking for interest income from their savings or retirees trying to generate reliable income streams from their retirement assets have suffered. One way to think about interest rates is that they represent the price of money. If you want to borrow more of it, it is only reasonable to expect to pay lenders for their privilege. We all know that there is no free lunch. For corporations and governments, such borrowing typically takes issuing bonds like a mortgage. The issuer of the bond, the borrower, agrees to pay the face value of the bond, the loan amount, at the maturity of the bond to the investor, the lender, along with the stated amount of interest. This is the way the bond world has worked for thousands of years. In fact, scholars can trace the interest rates on bond issuances as far back as 3000 BC. As always, an investor's best defense against uncertainty is a diversified portfolio that is appropriately matched to their tolerance for and ability to withstand risk. Moreover, in a world with low, if not hostile, interest rates, having a sound financial plan that considers long-term income needs relative to sources of payment and the need to preserve principal becomes even more critical. That's all for today. Make sure to hit the like button and subscribe to the channel to get more informative videos like that.